Stifel Nicolaus, market strategist. Kevin Caron is here with us on the Inside Track. So, Kevin, good morning to you. Dominic was just bringing us two views that I wonder whether they're not necessarily irreconcilable. You have Ed Yardeni on the one hand saying we don't really need more stimulus, but Kamal Stewart-Kumar from Trust Company of the West saying, well, the markets are hooked on it. Is that more or less the case, that perhaps the economy doesn't need another shot from the Fed, but that's what investors need if they're going to drive risk asset stock prices higher?
Well, certainly it's the case that the Fed has been making all along, which is that the economy really has not gotten back to a place where credit is being created normally, and they really do need to continue to keep credit flowing to have the economy continue along a path to recovery. But as the data has come in over the last several months, the economy does look better. So it creates a catch-22 for the Fed, where the data, they're happy to see the growth, but it does call into question whether QE3 is necessary.
And on the other side of the Atlantic Ocean, things are flaring up again. Everybody's watching Spain, which is obviously a much bigger deal than Greece. So how does that impact U.S. markets? People are still trying to stomach what happened last year.
Yeah, well, it's a recurring theme, isn't it? What we've seen has been a recurrence of problems within the banking system, and we're not yet at a point where banks are able to stand on their own. We've had intervention after intervention, but we have not yet gotten to a point where we see whether or not private markets are willing to sustain these markets of themselves, and we really won't know that for a while. But what would really be nice to see is some growth in the economy, because I think that would give that would help to bring private investors into those markets.
Well, with the ECB liquidity injections or LTRO auctions, it was a soft understanding these European banks would take this money and go out and buy up sovereign debt. Well, that doesn't seem to be the case yesterday. Are we seeing a slowdown from these European banks? And if there is one, what is it going to say for the broader market? I mean, do you really see real money accounts saying, well, if SocGen's not going to buy up Spain's paper, I will? Yeah,
really, you do need a borrower of last resort to counterbalance the lender of the last resort, don't you? And we haven't really seen that. Although in the U.S., bringing it back here for a minute, we are seeing some improvement in credit borrowing here in the United States. So credit card balances that are going higher. We are seeing some improvement in housing, for example. But it's a process, and it's going to take. It was a very significant boom that we had, and the credit bust is the other side of that, and it's going to take a while for that to work out.
Let's stay on that, bringing things back to home, because earnings season begins next week, and a lot of talk is about the revenue growth, the focus once again, but revenue growth slowing because of what's going on overseas, whether it's Europe, whether it's Asia.
Sure. Well, revenue growth is going to be there, but it's not going to be robust, nor is top line or bottom line growth, because profit margins are already near peak levels. What we're hoping for is some modest growth in earnings. We don't see explosive earnings growth from here. And I think that when you look at corporations and what they're doing with their revenue, a lot of it so far has been productivity gains coming out of the recession, a big boost in earnings. But from here, we need to actually see more hiring. We need corporations spending more. A lot of the issuance of new debt, for example, has gone to refinancing, not capital expenditures. We need to see that move along the continuum so that we can get real sustainable growth driven by business investment. And probably one of the nicest things to see over the last few months has been really sustainable gains in private sector payroll growth, not government jobs. You're really seeing the private sector step up and have to now hire people if they want to grow.
So, Kevin, what happens if that continues? What happens if we do see positive earnings growth over the course of the year? What happens if the payroll gains are sustainable and continue? Yeah. What happens if the Fed early next year, middle of the way through next year, has to start raising interest rates?
Well, I think that's actually a good problem to have. If you look back at most cycles, actually, you tend to do reasonably well in terms of risk assets. Once the economy really takes hold and starts to get some traction, the markets can sustain higher interest rates. We're now going into, is it the 6th year maybe, or the 7th year by the time they wrap up the zero interest rate policy pledge in 2014? That's an inordinately long time to have rates that low. I think there are a lot of folks who would like to see higher rates and a more normal kind of profile for the economy. So it's important to watch the fundamentals. We see fundamentals improving, and I think if you look at valuations on equities compared to bonds, I think the earnings yield, for example, is very attractive relative to bond yields.
All right, Kevin, great to see you, and thank you for coming this morning. Kevin Caron, market strategist at Stifel Nicolaus here on the Inside Track.